Good morning, welcome, and thank you for joining us this morning. As Simon said, my name is Elliot Refson. I'm the head of funds at Jersey Finance. A part of my role is to help shape the product offering of Jersey PLC, and the other part is to tell people what that is. I'm simply going to overview the new sector of tokenization of real-world assets before passing back to Simon to introduce his panel for today's session. And we have an extremely strong panel. So I'm simply going to highlight in 4 clear points why the sector will grow more rapidly than most people expect, and finally touch on Jersey's offering in the space. To begin with the what and the why of the digitalization of real-world assets. What is it? The digitalization of real-world assets refers to the process of converting tangible and intangible assets into digital tokens that can be managed, traded, and stored on a blockchain. Why does it matter? The tokenization of real-world assets presents substantial benefits to enhance liquidity, reduce costs, improve transparency, decentralize ownership, increase accessibility, offer diversification opportunities, and streamline the administrative process. Turning to the state of the market. Real-world assets that were tokenized total $13 billion at the end of 2024. And whilst this is not a huge number, we will go on to see the industry expectations and the factors that are expected to drive this sector into the trillions of dollars by 2030. And here are the 4 reasons why. The first is that for the reasons I've touched on, the tokenization of real-world assets is the natural evolution of financial markets. And history shows that one thing that we do as humans is to iterate and to innovate and to make things better. The second reason is that globally there is a clear and persistent trend to the reduction of pooled investment vehicles in favor of smaller funds of one and commingled vehicles. This trend is being driven by investors and their desire to have more control of their capital and investments. The tokenization of real-world assets helps to facilitate this. Today, established financial institutions and investment managers such as BlackRock, JP Morgan, Goldman Sachs are implementing tokenization strategies into their core offering. The third reason is the high net worth individuals and family offices want access to alternative investments for their enhanced returns and diversification. At the same time, alternative investment managers want access to this new investor base. It is this symbiosis that is driving the sector and which I believe will lead to its snowballing. But let me put that in numbers. The Bain Global Private Equity Report notes that individual investors hold roughly 50% of the estimated 295 trillion of global AUM. But those same investors represent just 16% of AUM held by alternative investment managers. And in simple terms, that offers a $150 trillion opportunity. The fourth and last reason is the precedent already set. The tokenization of real-world assets grew out of the virtual asset sector. The plumbing is the same. Virtual assets such as Bitcoin emerged over a decade ago as a revolutionary concept. And initially they faced skepticism. However, 10 years on, and the virtual assets market is now worth over $3 trillion. This sets a precedent in the trajectory for the pickup in demand for the tokenization of real-world assets, which also has the added attraction of already being acceptable investment mediums. Let me now turn to Jersey's position in this new market. In Jersey, our base case is stability, both political stability and fiscal stability, as well as a minimal change outlook from a regulatory, legal, or economic perspective, and that's underpinned by world-class infrastructure. For example, we have the fastest broadband in the world, and by the broad and deep expertise of the 14,000 people who work in our industry. This has led to our reputation and regulation being acknowledged positively by independent assessments from some of the world's leading bodies, including the OECD, the IMF, and the World Bank, and more recently, Jersey's extremely positive Moneyval assessment. Over and above that, there is one key factor that sets Jersey apart from our other jurisdictions, and that is the almost unique and collaborative approach taken by our industry, our service providers, our government, and our regulator, which has for many years led to highly successful innovation. It was this approach which led to Jersey regulating the world's first Bitcoin fund in 2014, which led to Jersey being the first jurisdiction to apply an AML control framework for virtual currency exchanges in 2016, and which led to ICO guidance in 2018. To highlight just a few of the key milestones of Jersey's leadership in the space. More recently, in August last year, the latest iteration of this collaboration led to our regulator, the Jersey Financial Services Commission, issuing two guidance documents. The first being the tokenization of real-world assets, and the second being the initial coin token offering guidance, with the latter being an update to the original ICO guidance from 2018. Both of these documents were aimed at recognizing the innovative potential of blockchain technology and to promote Jersey's competitiveness as an international financial center by clarifying the regulator's regulatory expectations in relation to this technology. With these frameworks in place giving us a focal point, let me finish by highlighting the 5 key features of Jersey's offering, which underline how different this new world is and why Jersey will lead in this area. The first is that Jersey treats tokenization in the same way as securitization vehicles and has a long history of CLO securitization structures, and our institution and regulator are well versed in the formation of these vehicles. This is bread and butter business for Jersey. Under Jersey law, a securitization vehicle is not treated as an investment fund, and as such, securitization vehicles are out scope of the European AIFMD directive. The third feature is that client due diligence is only required on the issuance and redemption of a token, thereby streamlining the process and reducing the need for repetitive CDD on the transfer of tokens. Unlike other jurisdictions, Jersey law does not impose limitations on the number of note holders for securitization vehicles. And most importantly, in Jersey, unlike other jurisdictions, and uniquely, the regulator, the Jersey Financial Services Commission, issues a consent to confirm the structure, which is a proactive confirmation that it complies effectively with regulation, which gives a degree of certainty that is not available elsewhere. So to me, our proposition is proven, flexible, and comes with regulatory clarity. And to quote our regulator, we are now open for new applications in this area. And with that, let me pass to Simon to introduce his panel.
Well said.
Welcome again, everybody, both of you in the room. And we have a studio audience here with us in Miami and a much larger worldwide audience. If you would like to join in and ask questions, please do. If you're in the room, just put your hand up and we'll try and come to you as soon as we possibly can. And if you are online, just use the Q&A button you will see at the bottom of your screen. As last year, we have a great worldwide audience. I think we have a few people in the Gulf, we have people across Europe, we have people across the US as well. So welcome to you all. We're delighted to have you here with us today. My name is Simon Osborne. I am the CEO of IFI Global. We are a research and media business based in the City of London. We have 3 monthly publications. One of them, which has been reconfigured and changing its name this month, is called Alternative Investment Strategies. And as its name implies, it's very much focused upon the areas that Elliot was just talking about in his introduction. And it will particularly be focusing upon the adoption of alternative or private assets or real world assets, whatever terminology you like to use, in terms of tokenization development in that area, amongst other things that it will be covering. So that is launching next week. That's the first issue of AIS, Alternative Investment Strategies. And we are very keen to talk to anybody about how we can measure the adoption across private equity, private debt, real estate, you name it, particularly the illiquid alternative strategies. So with me on the panel today, we have Erica Gemma on my right-hand side. She is, I've got this laptop on this very high-tech swinging device, so you can see Erica right there. And further to her right is Herwig Konings. He is the CEO of Security Token Market. Both of them are Miami locals. We're delighted to have you here with us this morning. And turning this thing round the other way, we have another local Southern Floridian. I don't think we do call you Miami, but certainly Southern Florida.
I'm a Bostonian that happens to live in Florida.
Okay, he's never going to admit to being a local. Fair enough, fair enough. And this is Dan Strackman, who's the managing partner of A&C Advisors. And on his left, we have Dilman Leach, who's a partner at Walker's. And on my furthest left is Philip Pericki, who is the head of Americas for Jersey. Oh, sorry. Thank you very much. Thank you, Erica. He's there. You can see him. He's the head of Americas for Jersey Finance. So welcome to you all, to the panel. I'm going to ask everyone just to say, by way of introduction, a few words about their background and their particular interest in this topic. Erica, can we come to you first?
Yeah, sure. Hi, everybody online and in person. I'm Erica Gemma. I have a background in digital assets. Primarily got into it because I was very interested in Bitcoin and just the way that opened up markets in the just in general, right? The technology of it. I met Elliot through Josh. Josh is a funds lawyer for one of our funds, and just been helping them for the last 3 years, just understand the security token market from the ground up. My first project in the actual blockchain space was I used to work in trade finance for in aviation, and this is where I met Herwig years ago. Because when I worked in corporate America at this aircraft leasing and trading firm, our project was we wanted to tokenize the fleet of airplanes, and this was back in probably 2017. So it was called security token offerings back then. I mean, it went from security token offerings to now real world assets is the acceptable term. We had some names in the middle of that, but I think RWA is what we're landing on. So I'm just really interested in how we can use the technology of blockchain to upgrade what we already have in terms of traditional markets. And so just, yeah, an interested learner, and I hope to be able to teach you guys something.
Thank you very much. Herwig, over to you.
With pleasure. Great to meet everybody. Thanks for coming to Miami. Sorry, the London weather apology here, but great to meet everybody virtually as well. By a little bit of background, I actually have a bit of a regulatory sort of compliance lens. So before this is sort of a reg tech company that does accreditation software, now also KYC, AML, background checks, and other things, primarily working with online fundraising platforms, large investment programs, and the like. That I am not a lawyer, not a securities attorney, but definitely know the compliance world very well. And as a result of that, started getting into the consulting world around 2016, 2017, when blockchain entered the space. We saw ICO offerings come into our technology. We saw already how the sort of landscape was evolving to do digital fundraising. Tokenization just really adds this steroids technology layer on top, and that's where I also got to meet Erica through that consulting firm. But most people know us for Security Token Market, or STM.co, but we track the market. We plug into the different broker dealers that already support these different assets. We do a lot of research around the market activity. We have a weekly podcast, an annual conference, next one coming up in New York in April. So we're very plugged into the space, and I like to kind of just call myself the industry's biggest cheerleader, because I believe tokenization is the future operating system for all capital markets, public equities, private markets, and everything else that's out there. So I'm looking forward to talking about this. It's my favorite topic.
Fantastic. Thank you very much. And on my left here is Dan. Over to you.
Thank you, Simon. It's a pleasure to be here. First of all, I want to say hello and give a shout out to all my students in Tallahassee. For those of you who are signed in, you get a little extra credit. Second of all, ANC Advisors has been around for about 25 years. We're strategic consultants to investment managers. We provide independent directorships to funds all over the world, and we are involved with the ARCA fund, the ARCA US Treasury Fund, which is the first 40 Act product that was ever allowed to exist in the tokenization and cryptocurrency world. So that's all I got to say.
Okay, thank you. And Dilmas.
Hi Simon, thank you. So I'm Dilman Leach, I'm a partner at Walkers, which is the world's largest offshore law firm. I started off at Herbert Smith Freehills in London. I moved offshore in 2012 as a funds lawyer. And then I started getting into digital assets around 2016 when Jersey introduced law around virtual currency exchange. And we helped some of the first businesses get licensed in Jersey from an AML perspective around virtual currency exchange. But in 2017, I was a founding member of the Jersey Digital Assets Working Group, and we lobbied the government and the regulator to produce some guidance notes around ICOs as it was back then. And the regulator published those guidance notes in 2018, which was pretty much when ICOs fell off a cliff. But we had those guidance notes published, which was great. And so more recently, we've been working on a lot of real world asset tokenization projects. So we got the first Jersey real world asset tokenization platform launched in March 2024 last year, and now we're working on a bunch of others. And again, we've worked closely with the government, the regulator, and Jersey Finance to get some guidance notes published about real world asset tokenization. Those guidance notes were published in August, just gone. So that's fantastic. It's now the regulator saying you can do real world asset tokenization and the issuance of stablecoin from Jersey, and these are the rules. And that's how I've got involved, and we're working on multiple projects in this area, which is very exciting, and I'm delighted to be here.
Thank you. And Philip.
Good morning, everyone. And Simon, thank you for having me here. My name is Philip Parecki. I'm the Americas lead for Jersey Finance. As a quick whistle stop tour through my career, it's been investment banking and asset management. But my particular interest in this area goes back about a decade when I was trying to build an indexed insurance product on the blockchain for small stakeholder farmers. And the sort of infrastructure, I think the sort of capital market infrastructure possibility of blockchain became very apparent. And I've just each year on year gotten more interested in this particular area. And from a Jersey Finance perspective, about 4 years ago, a large US asset manager was looking for a jurisdiction to structure these products. And it put us into a position to actually go through the mechanics of it for US managers trying to find places to structure something like this, putting it back on the table. So this area, in turn, I know it was said earlier, but if you're looking forward, the efficiency of this technology to take what is antiquated capital markets plumbing and bring it into the 21st century, it's apparent. Is this going to be the year that it happens at scale? Possibly, but we'll be talking about that today.
Fantastic. Great. Well, let's get into it. We have a number of questions that we are going to hopefully be rattling through, and I'm going to repeat what I said a few minutes ago. We do really want to hear from you, all of you around the world, and indeed those of you in the studio audience with us here in Miami. Please do try and jump in. We might, but we won't necessarily have a formal Q&A period at the end. We'll just see how things go. If you want to disagree or endorse a point someone's making, just chip in whenever you feel so inclined to do. So the first question I would like to put to the panel is, most tokenization developments to date have been in liquid areas of the market. Do you expect that the illiquid private markets, which Elliot was talking about, that we at IFI Global have a particular interest in as well, will start catching up, particularly this year? And if not, when do you think that is going to happen? I think I'm going to come to you first, Howard, because you are arguably, from what you said in your introduction, most optimistic, although I'm sure Erica is too. But what's your view on that?
pretty bullish, but maybe I'll set the stage in terms of your question. I mean, if we look at sort of the new terminology being RWAs, right, real world assets, the big use case, we're not even talking about securities yet, we're talking about cash, right? We saw a huge growth in stable coins this year alone and in the past. Before COVID, it was like a $5 billion market cap. Today it's over 200 billion.
Wow.
And I think that could well 2x or maybe even 3x, this year. So we're expecting to see a large continued usage of on-chain cash. And that changes the game for how we use the technology, but also changes the game for, intermittence. SpaceX was talking about how they use it for managing customer payments from around the world. We're seeing it beyond just sort of DeFi or crypto, where you're seeing stablecoins be used in real use cases, using it as a settlement tool for an on-chain securities transaction, right? If we have on one end a tokenized fund and you want to settle into that in cash, why do that in the Web 2-way when you could just do an atomic swap, right? Just like I can send a Bitcoin directly to somebody, or we can do an exchange for a token to token. We can do that with cash and with a security, but you need to have that cash element on chain. So I think that's the first big, topic that we're going to continue to see more traction on this year, is we're going to see this growth of usage of on-chain cash. But with it, we're seeing another trend with on-chain money market funds or on-chain liquidity products, treasury funds, things like that, to back up these stable coins or to use as collateral and other use cases. So these are sort of the first two big trends, I could say, that are being formed around RWAs. And to your point, those are very liquid markets. And everybody, at least when we first started into this space, the promise of tokenization was, we're going to tokenize illiquid markets. You're going to see private funds and startups and other things that never before traded. You're going to be able to, trade them by retail investors and things like that. Of course, seeing how the market has matured over the last 7-8 years since this concept has been around, we're now seeing that it's the opposite. We're starting down on sort of this liquidity curve and going down the road, but that hasn't stopped real estate from being tokenized in all manners, from title into SPVs, into, debt offerings and funds. That hasn't stopped commodities from being tokenized, or private equity and private credit vehicles and the like. It's just a big myth is that there is liquidity there. There really isn't. We know, because we track these markets directly with our website. So what are hundreds of millions and billions of dollars worth of tokenized assets have hundreds of thousands or millions of dollars in trading volume, right? Which is very, very insignificant, but you could argue is pretty significant compared to nothing, right? No trading whatsoever. So there's just this interesting trend that I think over time we're going to see more markets develop and they become more liquid. But today, the focus, to end my point here, is going to be around primary markets when it comes to liquid assets. So we've seen KKR, Hamilton Lane, and many others start to sort of test this technology out, not to say, hey, you can trade our funds, but to say, hey, we're going to go reach new customers at a reduced ticket price and scale up our AUM from a primary perspective, and allow redemptions out of our funds in some cases, but not allow for the secondary trading of the LP position, for example. So hopefully that captures your.
Excellent, thank you. And since the camera is pointed this way, can I come to you next, Erica?
Yeah, I think in terms of liquid markets, stablecoins are huge. Tokenized funds, I think as treasuries as well are being tokenized. BlackRock's is on money markets. That's what they tokenize. So those very liquid assets are already, just because the technology is better. But if I'm seeing a trend on where illiquid assets could utilize this, I think the #1 place is probably going to be with startups. Just because with startups, with this younger generation, they're gonna, from the ground up, when they
build it in when they start the business.
Exactly. And when you look at like Founders Institute and all these different organizations that help startups get started, they are teaching their startups real world assets and how they can incorporate that from the start. So illiquid, I see startups using it. That's probably the low hanging fruit. But obviously in the liquid space, the technology is just there, so it's being captured.
That's the first time that thought has been given to me, that you could see alternative stroke private asset managers starting up with this intention and maybe leapfrogging some of the, not the BlackRock, the bigger players, but some of the less well-known players who haven't got the resources to do it, that could change the entire market, maybe.
Yeah, and then if you look at it as well, it's like, when you capture this next generation of wealth, it is these younger people who are used to using stable coins in order
Yes.
to get into a meme coin or something like
Yes,
that.
yeah.
And those are gonna be the people that will invest.
Great, let's go right down the other end of the table. And Philip, do you have any thoughts on when do you think the development will happen in this illiquid area of the market?
Well, I thought it was 5 years ago. So, I mean, that's a place to start. I think the point, the liquidity issue, so is the volume there today? Well, I think the right way to look at it is not, is it there today? It's actually to see where the growth has been recently. So if you just look over the last few years, so I think we'll use maybe pre-COVID, post-COVID, that gives you the sort of trajectory that you can see some pretty substantial growth. But when you actually start thinking through how you go into this, Erica mentioned younger generation. I mean, this is like a natural process for them. And I was, this is sort of anecdotal, but a month ago, someone and I were talking actually here in Miami about this very subject, about younger people getting much more comfortable with this. Actually, it was brought up that this is actually an environment younger people have been in since they started gaming. And it kind of penny dropped that if you built an entire mental framework that digital assets have value and that you can operate in this environment, it's a much more natural transition. So I think startups, more and more startups in this area, going back to your question, this is the year I think we see it happen. If we get, particularly in the United States, greater regulatory clarity around how you do that.
We're going to come on to that subject of regulations in a few minutes, but yeah, a good point. And Dilman.
Yes, I just made a list of, so we're working with a number of clients tokenizing real world assets, and Walker's was the largest offshore firm. We act for everyone from institutional household name asset managers and blue chip firms right down to pre-funded startups. So we have a real good view of the markets and what people are doing. The clients at the top end of the market, we're tokenizing listed US Treasury bills and listed shares. And cash, so stable coin, effectively. With our kind of smaller, more startup clients, we are already tokenizing less liquid assets. So we've got a few really interesting projects, tokenizing wine, gold, private credit, fund interests, real estate, and bonds. So quite a good range, but the scale is very small. And as Herbert was saying, there isn't really liquidity, even in those very big tokenized money market funds. There isn't genuinely that much liquidity and trading of those interests. I think it still is kind of proof of concept, if you like. But I think, as you say, this could be the year where a significant number of new projects come online, with scale, and right down from the startups up to the biggest institutions in this area.
Thanks. And Dan, you sort of half mentioned it in your introduction, but you are on the board, I think, of a money market fund with a tokenized option.
Right.
And what's your view on when and if the activity will move into the illiquid space?
Yeah, so I have a little bit of a different view than I think everyone on this panel. I think the reality is this subject is something we've been talking about for years. We've been saying this is going to be the year, this is going to be the year. The reality is it may be, it may not be. The problem is education. Right now, people don't know what we're talking about, perhaps not in this audience, but in the real world, with real world assets, if we're going to call them that. They don't know what this tokenization really means. They've heard about it, they've read about it, maybe, but that's the key here. The key for the year to happen is going to be education. Whether that's this year, I don't know, but I think that's the biggest issue. The other issue is, Philip brings up a very interesting point about, people who've been playing video games and been, getting coins and getting access to things of that nature. I think that's true. But the flip side of that is the young people who are doing that need to have a job. They need to go to work. They need to have assets which they can invest. And we've seen that let's call it the generation, I don't know what you even call these people anymore, but the younger generation doesn't like working. doesn't want to go to the office, doesn't have liquid savings. So I think we can't rely on them to take this industry to the next level. What we can do is rely on education to institutional investors, sophisticated high net worth investors, those likes, who can then figure out a way that this is a tool that they can use to better manage their portfolios and their assets.
Okay, let's move. I see you've already got, in fact, we've got two questions have already come in. Before I get into asking my next question, let's see what they are. Oh my God, this happened last year. We suddenly got an explosion of questions. And we've got
They're all
three
my-
questions. What? So let me just read them out. I'm not saying we're going to come to them. I'll just tell you, we just already got these questions. Why hasn't there been more adoption of tokenization in the liquid alternative asset classes? That's what we're talking about. Sorry, sir or madam who sent this, other than real estate. That was one question. Are there any industry figures on tokenization take up by asset classes? And what is the process and cost associated with tokenizing a standard typical fund? We are going to come on to that when we have a question partly designed for Erica about how you do that. So these are our actual subjects. Thank you for those. Keep them coming. I think I'm going to stick to what I was going to go to next, which is partly what's touched upon in one of those questions there, and also partly what you guys were talking about in terms of age. But let's get beyond age and talk about family offices, high net worth individuals, even the retail market, as well as the traditional institutional market. Which investor categories are likely to be most attracted to on-chain investing? So this is not an age, it's more of an investor category question. And how likely is it that family offices, high net worth investors will access opportunities in private markets through tokenized options? By the way, we're writing a white paper at the moment. One of the things that came out time and again, if you look at all the research that's been done by reputable the McKinseys and the KPMGs and the PwCs, is that if you look at the family office and the really ultra high net worth market, they're really under invested in these illiquid alternative asset spaces because the minimums are so high, liquidity is terrible, transparency is terrible. It's obviously been a market that's been completely geared to the large, huge pension funds, not even the small pension funds, the really large pension funds. Is tokenization an opportunity for them to get in? I know JP Morgan is pushing this very hard, amongst others. Is this going to happen? Let's kind of reverse the order this time. And I know you're a bit skeptical upon this. Dan, do you want, on whether or not that market, the ultra high net worth family office market, will use tokenization to access private assets?
So before I get that, someone had asked a question about why real estate.
Yeah.
And the simple reason is because you can touch, feel it, and see it, right? So I can't see bonds, I can't see equities, I can't see cash, but I can see real estate. I could drive to the building and, knock on the doors or whatever. So I think that's why real estate, and it's a natural, right, to sell people a share of a building, so to speak. Look, institutional investors lead the way in what all investors end up doing eventually. And so if institutional investors don't have a significant adoption to tokenization, then we will see the sheep of family offices and high net worth follow them into that marketplace. So that's my view on this. That most investors are sheep, and as a result of that, they'll follow what CalPERS, CalSTRS, OTPP, British Rail, etc. do.
Okay. And Dilman and Philip, whilst we're pointing in this direction, any thoughts on investor category take up?
I think what my clients are saying is that quite a few of my clients are technology companies who are looking to form a tokenization platform in some way or other. And what they're looking to do by forming a tokenization vehicle is to access some of the $3 trillion held in Bitcoin and stablecoin. So those people who already hold Bitcoin and stablecoin, what my clients are doing is bringing traditional financial instruments on chain so they can have exposure to those traditional assets without having to sell out of Bitcoin or USDC and get dollars, and then go on the traditional rails to have access to those traditional assets. That's the very basic initial use case for some of my clients. It's just bringing traditional assets on chain to access that Bitcoin and stablecoin that's there.
Yeah. Philip,
Well-
what thoughts do you have on this?
Well, back onto the, your point about real estate, why real estate, well, I think there's an obvious play here. It's, you know, it's a large assets, a lot of cash tied up into it, so people can be, you know, somewhat of a cliche, but, land rich and cash poor. You want to control the asset or maintain the asset, but you want liquidity, so it seems like that would be one way to do it. But get liquidity from multiple parties rather than have one person that you're negotiating with that can push you on price. So I think the inclination is to go into that direction. But I think there's a bigger conversation here about, and this will come back to a point that was made earlier, just actually about the capital market infrastructure here. I mean, we can think about the assets, and one of the driving forces behind the institutionalization of this is efficiency, right? And so, yes, you can think of efficiency in terms of speed and cost, but it's also what you can build on top of that efficiency. So the energy behind this is to actually move away from a lot of antiquated, slower and expensive ways of doing things.
Yeah, that's a good point, with the operational benefits of it, that's true. And so on to the other side, again, any thoughts you guys have over here on the investor category take up?
Yeah, I think when there's a statistic that says 80% of family offices are looking at blockchain and cryptocurrencies, I think a lot of family offices are creating an alternative investments division specifically to look into these things. But just to go to your question, which you're talking about on-chain investing, which to me, on-chain investing means direct crypto into crypto. You're staying in that ecosystem. You're not necessarily tapping back into this world that we live in now, traditional finance. I think when you look at the market for that, and I'm gonna have to disagree with you a little bit, Dan, when you say that young people don't want to work, I think that young people don't want to work for $12 an hour at a job that has no upward mobility. But they're finding ways to work online to be able to make money quickly online, and just new ways to make money that didn't really exist. But these young people and investors that are just native to on-chain worlds, these are the people that are going to be investing into the startups. These are the people that are going to be using the stable coins, the tokenized dollars that are already in the system. Those are the people that are using it now, and I think that's going to continue to grow. I mean, who is used to 24/7 trading, being able to sell at 2 a.m. on a Sunday morning, right? So yeah, that's just the market that I think you're going to get into it. Even though family offices are already there, I would say the family offices that are more prone to getting interested are family offices that have younger participants that are inputting their thoughts into the family business.
Okay. Oh.
Yeah, I think we covered a lot of the main trends, but if we just listen to the heads of CEOs of BlackRock, Franklin Templeton, Hamilton Lane, Wisdom Tree, and many others, they're all seeing where the puck is going, right? They're saying if we want to continue to grow AUM, if we want to go downstream, because the pension funds and everybody else are already squeezed up for all their funds, they got to lower the ticket minimums and they got to meet the investor where they are, which is digitally. Right, and so tokenization offers both those options, thanks to efficiencies on the back office to enable lowering that ticket minimums, to enable administrating multiple investors easier, and then of course distribute it. Right now, they're actually removing, in many cases, concentrations that they have on distribution partners to help them raise capital, and instead going direct to consumer, whether it's retail, like Wisdom Tree has done with their app, or Benji with Franklin Templeton, or whether it's sophisticated high net worths or family offices with a lot of these products that are going from 5 million minimums to $100,000 minimum investments, right? And their target is not retail, obviously sophisticated, accredited investors and family offices. So I think this is the natural trend. We're already seeing it start to happen. And we're seeing a lot of the leaders within this field vocally say that this is their plan. So
Okay. We've had, I'm delighted, and I'll come to them in a minute. I see there's been yet two more questions coming in from the online audience, but I'm going to go straight to the next question, which I'm particularly looking forward to ask, because it seems like a month ago, but it was only Monday. What day is it today? Thursday. We've got a new president here in this country. And at the weekend before he became president, he and his wife launched a couple of digicoins. I wonder how many people online and in the room have invested in Trump or Melania's digicoins. But he has, let's put it like this, probably a different perspective on the world of online than his predecessor had. It's probably the simplest and the politest way of putting it. So with that in mind, what is the regulatory outlook for digital investing, both here in the US, in light of the new administration in Washington, DC, and indeed elsewhere, because we have a funds lawyer from Jersey on the panel too, and Walkers is very much, of course, a global firm. So I'd be very interested in the non-US perspective on this question too. I'm going to stick down here with the Yanks on what, I think, Erica, you said that Trump's son-in-law is in the same, when I visited, he's in the same building as you. I don't know whether you talked to him in the elevator about tokenized investing or anything like that.
No, I've never ran into him in an elevator, but yeah, he is in the same building as me. But no, in terms of your question, the US is behind. I think it's Singapore, Switzerland, those are probably two top places when it comes to utilizing this technology to tokenize. The US is behind probably because we have the strongest and like most strict investor laws, and so it's a little bit hard to break away from those. But I think Trump coin and Melania coin, those are memes. That's absolutely a whole different sector than what we're talking about today.
I was joking.
Yeah, but you see that he's friendly towards the technology. The fact that you see that the president launched a meme coin, obviously meme coins, which are purely speculative, are legal, right? You're not going to see issues in that sense. But when you look at who he's appointed, who is very, very pro-crypto, Hester Pierce, I think she wrote against the Dodd-Frank bill. We call her crypto mom. She says, I'm not your mom though, guys. She's like, stop calling me mom. But Hester Pierce, she got elected as the head of the crypto task force. There is a crypto and an AI czar, David Sachs. You see these people be very, very pro things that are happening on the blockchain. I think another one is the Federal Reserve Vice Chairman is Michael Barr. Michael Barr has said very pro things towards blockchain. And then Jared Bernstein, who's the chair of the Council of Economic Advisors. He's embraced tech advancements in many different ways. When you look at the lobbying power of the crypto industry, there's a organization, I'm pretty sure it's called Fair Shake. Every single candidate that this organization put their money and their power behind, they won virtually every single race. And so when you're looking at this new asset class, this new generation of people that are trying to shape policy, the industry of blockchain is very active. And so I just think that hopefully the US will not fall far behind any longer, just because it is an upgrade in technology. I think that especially in the security token space, that's how it should be viewed, is just a upgrade of technology. But yeah, right now we're just behind, but I think that's going to change with Trump because he's a businessman.
Yeah. Okay. Well, it's going to be very, 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 very interesting to see what happens as the year progresses. Yes. Herwig.
Yeah, I mean, it'll be interesting in general what he does for the crypto industry. Unfortunately, whether we like it or not, the tokenization of real world assets and crypto for many people due to a lack of education bundle the two together. And so there is this kind of myth that to many people, they still think you can't even tokenize assets today, right? And that's obviously a myth. We know that there are billions of dollars of assets here in the US that have been tokenized, publicly registered and other things. So nothing is stopping that, but certainly there's a lot that can be improved. In fact, we saw many years ago, and actually we heard it earlier from the example of Jersey, right? Even this concept of just having some legal language that says we can use the blockchain as a source of truth, or we treat, tokenized securities the same as regular securities, that will give financial institutions so much comfort and clarity that they're more willing to participate, because that's where a lot of them been the reason that's holding them up from getting into the space, because it's not possible to do it. It's just more of the skepticism and how regulators are viewing it. And now with the new administration, there's a more of a euphoria, a better positive sentiment regarding how the administration and the new SEC might, treat this industry. And therefore, people are more willing to embrace it. When I say people, I'm specifically referring to institutions that are gonna be driving a lot of the new product creation, a lot of the new adoption this year. But also in general, we do hope that this means there's gonna be a lot more startups and other smaller projects looking to take advantage of the technology, because what happened with ICOs ultimately, led to sort of the death of that industry here in the United States, and RWAs sort of tried to flourish out of that, but now hopefully with both of them kind of getting a reset and a fresh positive, I guess, look from the new administration, hence the meme coins. I think that's gonna, play positively for both of each other. It's gonna lead to more adoption. When we see the crypto markets do well, we also see tokenized assets and securities gain demand and interest, and things like that. So we definitely think it's a good thing in general. I'm very positive about the whole outlook, especially if things like the Bitcoin Strategic Reserve, or if no capital gains on some US-based cryptocurrency, if those things pass, again, that helps crypto, which helps RWAs. But to Erica's point, I think the right people are in place right now that have the right education, that are gonna put the right policy and the right, oversight in place for the growth of both crypto and RWAs in America. So yeah, very bullish.
I'm just going to throw something in from left field because the thoughts just occurred to me, and we'll please stay on the subject as well. But if we do see some of the stuff that you guys are talking about, particularly you, Herwig, just there, what does this do for the US dollar's reserve currency status around the world, which is actually declining anyway, irrespective of what's going on in the digital world? If there is global adoption, or whether it's Bitcoin or whatever else, this is going to hasten the decline of the US dollar as the world's global reserve currency. I throw that into the mix just because I felt I should. Dan, do you want to not necessarily pick that up, but I go back to the question of what's happening with regulation?
I'm gonna, agree with Eric and Tony. I think they said the right things about the administration. One of the things that we briefly mentioned was the SEC. I mean, I think that's the driver here. If the SEC becomes more RWA and crypto friendly, which we didn't have in the last administration, I think that could also be a massive driver. My concern is, though, you guys brought up this whole idea of large asset managers coming downstream, and we've seen this. This is not a movie we haven't seen before, right? We've seen hedge funds who created mutual funds. We've seen hedge funds who created products for the retail investor, and that signals one thing to me, is that they can't raise assets from the other markets that they've been operating, and that's a little scary, right? I think when we have to think that through a little bit better, and I think with the new SEC commissioner involved and him bringing on some real strong candidates, I think that we'll get there. In terms of the dollar going away, I think you're living in Peter Pan land. As long as barrels of oil are quoted in dollars, and no matter what Saudi Arabia tries to do and China tries to do, the U.S. currency will be the reserve currency for the world, at least until your end of life, most likely until my end of life, and most likely everyone in this room's end of life.
I don't want to get into a geopolitical discussion about the future of the world, but I just wanted to throw in whether the dollar is declining as the world reserve currency anyway, and whether or not the world will move to a more digital.
Said the guy whose empire crumbled.
All right, listen, there's so much. I think we should go offline and have a set.
Whenever you
Get our boxing gloves on, right?
Whenever you want.
Right. So, Dillman, actually, please give us, if you wouldn't mind, a view of regulating, particularly, of course, Jersey, but also what you see in the other parts of the world, which doubtless you're looking at Asia, because I know Walker's is big in Asia and in the Caribbean and wherever else you have offices.
Yep, sure. So offshore, it's quite simple, really. So whether it's Jersey, BVI, Cayman, Bermuda, and Guernsey, the jurisdictions where we operate. In Jersey, in a way, it's the simplest, but we have published guidance. So the regulator has said you can launch a tokenized structure out of Jersey, you can launch a stablecoin issuer out of Jersey. These are the rules. So absolute execution certainty, you can do it as long as you comply with these very basic rules, which is fantastic, and you get a proactive consent from the regulator to do it. But Jersey and the other offshore jurisdictions, they are the manufacturing jurisdiction. You create the product, but how do you sell it? That's the bigger issue. And so I had one interesting thing happened yesterday. A client asked me to look at some changes to their website. And because I'm currently in Miami, I can't even access the website to look at it because it's geo-blocked. So I'm looking at all of my clients at the moment. Currently, they all exclude the US entirely. So they don't issue tokens or market at all to the US, even if they're US-based clients. As regards marketing to the rest of the world, they all take quite different approaches, actually. So one client of mine wanted pan-European retail marketing. So as a Jersey issuer, we prepared a prospectus in compliance with the EU prospectus regulation. We've had the prospectus approved by the Liechtenstein regulator as the primary EU regulator. And then the product can be marketed across the whole of the EU on a passported basis, as long as you have enough translations of the prospectus. Another client is doing proactive EU marketing, but to professional investors only. So it's a much smaller prospectus we have to prepare to do that. Other clients are not proactively targeting Europe at all. So they're looking at, say, Asia and Middle East. Some clients don't touch the UK at all. Others proactively want to market into the UK, so they follow that process. So we see a real wide range of different approaches to distribution of these tokenized real world asset products.
Because when we've had these discussions before, and I think this came up last year and elsewhere, the thing that's often holding people back is just the lack of clarity on regulation. People just don't know what to do. And I don't want to be controversial, but I'm getting a sense that it's not much has changed since then. And Philip, you want to touch upon that? Or?
I think when we have these conversations about regulation, and you are right that the lack of clarity, and I think it's broadly accepted, the lack of clarity in the United States is what, to Erica, your point earlier, is what's sort of held a significant amount of growth in this area in the States back. But actually, sometimes I think we get too myopic when we talk about the regulatory issues because we end up focusing on specific regulations. So, and Dillman's quite right to say that if you wanted sort of execution certainty, you could go to Jersey as an example to get that sort of clarity up front. But it misses a more foundational point. So if you're looking at a jurisdiction, and I'm not saying that you're missing it, Dillman, my fault. But if you're looking at a jurisdiction for a place to structure, and Elliot mentioned this in his opening remarks, you need to be thinking about a jurisdiction that's forward-looking, that actually is doing the things, not just specific regulations, but they are doing the things that are making the jurisdiction itself foundationally a place to do business. So take Jersey as an example. Elliot mentioned that Jersey's got the fastest broadband speed in the world. True. And that's a really sexy top line figure. What you didn't hear is that the technology that underpins that, the government made a decision actively decades ago to put that infrastructure in so that that would be the case, so that the jurisdiction could be this 21st century place to do business. Furthermore, it's not one undersea cable servicing the island, it's 5 undersea cables. Why? Redundancy in depth. Again, that's a non-sexy decision the government made to add real infrastructure, real robust capabilities to the jurisdiction. Those are the things you need to be considering. So when I kind of look at the regulator itself, or a joined up approach of a jurisdiction where you actually have industry, you have government, you have the regulator, I hate, pardon the cliche again, in the trenches with you, that's the place you need to be going, because they're the ones that are going to actively find solutions with you to solve a lot of these problems.
Yeah, and just, to your point is that in the US, securities laws are clear. And this is what we're operating under, is securities laws. But in the US, there is this regulation by enforcement where you do something, you think you're okay, then they go after you. But obviously that's not a problem in Jersey.
I'm going to see what the further questions that have come in are about, and then we will go back on to the topics we have on our list here. I'll just read out the two more that have come in. How is the valuation of a token determined of a PE fund, hard to value assets? That may only be a NAV, quarter, semi-automatic. That's quite a technical question. I think we'll leave that one potentially to the end. And here's another one is, what are your thoughts on the tokenization of artwork as a potential hedge against market risk in the future? That may be a more fun one we'll leave for a little bit later. So let me move on to a slightly more technical subject, which is, I think we'll probably come to you first, Dilman. What are how are tokenized funds typically structured? Are their governance and service provider arrangements satisfactory? Because I have the impression, tell me if I'm wrong here, because you're in the process of doing these things on if not a very regular basis. Are people thinking about the governance? Because the traditional fund, you have a traditional board, they're overseeing that on behalf of the investors, blah, blah, blah. We all know that. If a fund is tokenizing with all these investors and secondary markets and all the other stuff, how does that work from a governance point of view?
So I should say that there is a small number of tokenized funds out there. So Walkers have acted on several of the largest household name manager funds, which have been mentioned already. They are still quite proof of concept, and I think there is in reality that much liquidity in these. And in reality, when it's a fund that's issuing a token, the token when it's intended to represent the share effectively. In reality, you issue a share as well as a token, and you have a service provider, a tokenization partner, who effectively keeps two registers, the one on the blockchain with the token and effectively another Excel spreadsheet for the actual shares. So I think there's a lot of marketing about tokenized funds and liquidity and wider access, but in reality, there's not permissionless transfers of fund interests, because where a token represents the share, you have to effectively, if you need to be a qualified professional investor, you have to meet that criteria anyway. And in reality, you actually hold the share and the token at the same time, where those tokenized funds are set up. What we have seen, however, is the formation of an SPV that will become an investor in the fund. So it's effectively a feeder-like vehicle. So it holds the shares in the fund, or limited partnership interest, and then it issues a token to investors. And that token is effectively a debt security, a tracker instrument. It tracks the value of the underlying fund interests. And that's a bit more interesting because it's a debt security, it can be traded permissionlessly on the blockchain without CDD on every single transfer, because it's a token, it's a debt security. The SPV won't be a fund because the tokens are a liability on its own balance sheet. It's not raising capital. It needs some analysis as to whether it's an A under AIFMD, if it's marketing into Europe. There are some complex things to work through, but we have seen that. So forming an SPV to tokenize fund interests, and that has some benefits in terms of permissionless transfer of those tokens and so on. The tokenized fund itself, in a way, it's still quite clunky as to how they operate, and I'm not sure of the benefits other than proof of concept, people saying yes, you can do it. And then there are things around the edges, like Hoeg mentioned about posting the tokens as collateral and things that can be some benefits.
Right. It was this is quite a technical area. Do you guys want to comment on that in terms of how a fund is structured? It's probably, I don't know how much of you get involved in this, because I'm going to come to you about if someone was walking in the door and didn't know anything about it, that'll be the next question coming. But before we get to that, do you have any thoughts on this?
I think it was well covered. Just about every type of instrument has been attempted or gone through some tokenization these days. So there's a lot of case studies to look at, and as we already highlighted earlier, even publicly registered funds here in the United States have been approved. So I think, this goes back to just kind of like the myth of, tokenization means you can't do it. And it's like, no, as long as you follow the current rules, you can use the technology to your advantage. Not much really to.
Yeah, I mean, there really is no standard. When you raise money for a company, you either raise an equity, debt, or security tokens, and then security tokens can represent either debt or equity, depending on what you guys choose as a company. But I don't really see like some standard. It just like there is no standard in creating a company in your cap table. There's no real standard in this. It's just a tool.
Okay, well, let's move on to the question of, let's go back, way back to the beginning, and let's talk about, let's imagine you know nothing about it, or let's say you're an asset manager, you're being way behind the curve, you need to be brought up to date, and somebody walks into your office, Erica, and says, what do I do? Here I am. What do we do? How do we go about it? What are the things we need to do? Well, here's my blank piece of paper. I'm here to make notes. Far away.
I would say if you're looking into asset tokenization, the first thing, I have some favorite companies that I like to send people to. One is 10XTS. They're very strong when it comes to just taking into account the ATSs, the broker dealers, all these people in the middle that already exist. They take those people into account with their token issuance. I think the second thing that I would probably point people to is a maybe more accessible company, something like a Republic. These are really large crowdfunders. And so they've been in the space of just technology since Web 2.0, right? Technically, we're in Web 3 right now. But they've just been VCs, crowdfunding, and when you look at someone who does crowdfunding, it is a natural fit for companies that also want to tokenize. So those are the two resources I would send you to. But then also just knowing Berwick for forever, I actually didn't know that you guys had such like a big presence in the media side of things. But they've been on top of the markets for quite
You go see Herwig. That's what you do.
Well,
Taking this up, Herwig. So Erica sent somebody to you. They said, nice to have met you, Erica. Hi, Herwig. What do we do now?
Great guy, actually. That's, we've consulted over 50 different asset managers, banks, startups, real estate groups, you name it. So we've seen it all. It usually breaks down again to, not much what you would do differently without blockchain in the equation, in many cases. So the legal, just making sure you have the right lawyers that can update the legal language to make sure you're, compliant on that front. Then you've got the technical, picking both the blockchain, but also a platform. This platform onboards investors, usually makes it easy for you to administrate your offering, as well as basically create a deal room, a digital deal room that you could send people to. And then from there, it's the classic, distribution, where now either you're relying on broker dealers in most traditional cases, or you're relying on an audience, like say Republic, like Erica recommended, has millions of customers that are already investing online, or you reach your own audience, right? You may already have a customer base, you may already have your own network of investors that you even want to keep closed, and you can kind of create this environment, whether private or public, that you can now have this, digital offering available in. So a lot of the time, I guess all I'm done is most of our clients don't really care so much about blockchain, right? It's more about the end goal of, can I raise money, or can I reach a certain user, or can I create liquidity? And it's working backwards from there. But I could go in all day on this, so I have to send you a bill, so.
Okay. Do anyone down this side of the table want to answer about how do you go about doing this?
I'd call Dylan.
Call Dylan. This is what he does
That's
all
what he
day.
does all day. right?
Yeah.
Well, thanks very much. Yeah, it is complicated. So when we're speaking to clients about forming a, tokenizing an asset, whatever it is, there's quite a lot of plumbing, and they're all quite bespoke still. So finding the right service providers is tricky. So the right tokenization partner, who's going to provide a bank account, who's going to look after the SPV and provide directors, company secretary, accounting, who's going to audit. There's quite a lot of work around that. So some of our clients are wanting to form their own kind of white label platform with all the plumbing built in to then provide a tokenization SPV with all the contracts all lined up. And that's quite exciting. I think we've got a number of clients looking to do that. because at the moment it is quite involved, bespoke and time consuming, just getting all those service providers lined up.
Yeah. In Jersey, you may already do it, Philip, but have a sort of a guide to what to do. Maybe for somebody in the Middle East or here or anywhere else for that matter, across Europe.
Actually, we do have a Jersey Finance. We have several pieces of research on the tokenization specific with respect to Jersey, and we actually have a landing page on this very topic,
Right.
actually at the Jersey Finance website.
Okay, great. Does anyone want to tackle these kind of technical questions? I've got one last killer question to put to the panel, but before I do that, does anyone want to answer the questions on the valuation question, which is quite a technical question? We probably need a fund administrator for that, so
Actually, I will.
all right,
Take-
okay. Do you want me to read it out again, or do you remember?
No, it's actually a broader subject. So this comes back to a point I made, and I'm going to use this. I might be using this phrase. I might be stretching its use a little, but composability. So the advantage of these on-chain solutions is what you can layer on top of those solutions. So there's nothing inherent about the on-chain with respect to valuation. So I can't remember precisely what the question was, but I think it might have been like a private equity structure and getting to valuation. You can layer on technology onto these tools. And I think that's the sort of part of this 21st century capital market infrastructure. So that's valuation tools, that's building smart contracts actually into these products. That's where this goes. These are things, there are things we can't even imagine 10 years from now that we'll be doing with these products. So it's not that the infrastructure itself gives you a valuation, it's what you can do with that infrastructure at speed and efficiently.
Okay, great. And I'm going to slightly alter the other question that came in to make it slightly broader. It's not just about artwork, which is your thoughts about tokenization of artwork as a potential hedge against market risk, but tokenization of anything in that kind of, for want of a better term, kind of not wacky, but kind of unusual from an investing point of view perspective, is tokenization. If you believe, like I think I might be, we're on the verge of a big market crash in the public markets, should you be tokenizing all these kind of wacky things that you can tokenize to hedge your portfolio?
I think if you look at art itself, like Warhol, I think some Picasso's, that market's like $200 million already. So it's being done.
Yeah, but I guess that's a question of whether you think the market's going to crash and whether you should be into these kind of things.
I think that's just the general, if you don't pick a side, but just in general, right? The idea is we're creating new building blocks where someone could go in and say, I want to buy big gold tokens, I want to buy some real estate, I want to buy some alternative funds, I want to basically put together a portfolio, or whether asset managers get to do that on behalf of their clients at immense scale. This is all changing thanks to tokenization. I remember there was I think it was JP Morgan using a couple different chains. So there's multiple blockchains representing multiple different products from Apollo, JP Morgan, and Wisdom Tree. And they did a rebalancing trial where I think it would take like 3,000 steps to take 100,000 portfolios and rebalance them. And it took them a couple of steps, right? A couple of clicks. That's all it took to rebalance all those portfolios. And that was with a limited number of models. So the idea that you can now tokenize all alternatives and all these different assets so that asset managers or investors individually can now really manage their own portfolio in new ways. I think that's kind of the exciting theme behind why tokenize some of those assets. But I think it was mentioned earlier on the other side of the table, the key is really still being able to sell it, right? Just because you tokenize it doesn't mean it's liquid and people will buy it, right? Exactly. So you still have to do all that work. But it's the efficiency and the technology that allows for it to be able to scale if you can figure that part out. So I think for sure we're going to see art continuing to be tokenized, and we're going to continue to see precious metals and all kinds of alternatives continue to be a popular use case.
Right, last question of the day for everybody, which is the forecast question. And you know, the joy of forecasts and the joy of this technology is we can see in a year or two or three how right or wrong you were this morning with your forecast. So I'm going to stick with you, Herwig, to start with, because I think you were the one that suggested we have the forecast question anyway. So you were going first in here. Yeah. So can you give us a forecast for this year, or what do you think is going to happen, and perhaps also over the next 3 years of particular note, that if we were sitting here in 12 months' time or in 3 years' time or whenever it may be, that will be different from today. There's so many crazy optimistic stuff by every reputable or not reputable outfit that forecasts this stuff about how quickly it's all going to grow. Anyway, over to you.
I'm very optimistic by nature as an individual, but also we are putting out a report in just a couple of weeks with our own predictions for the market as a research firm. So I got some numbers on this, but again, we're looking at today 200 billion in RWA stable coins, and then you got another 50 billion is really the accurate number that we track across both public and permissioned and private chains. There's almost 20 billion in tokenized bonds. There's another 30 billion across equities, whether they're funds, whether they're large companies, energy, etc. And I predict that that's probably going to at least 2x, but more likely 4x this year.
Up to 4x this year.
If we're going to break $1 trillion in RWAs by the end of the year, if we see the Trump administration and a crypto market that is booming, right? Because as I mentioned earlier, they're very much so tied. And I believe there's a massive trend with stablecoin being backed by on-chain money market funds. So if you've got 200 billion today, and we've only got 3 billion in tokenized money market funds, we're missing 197 billion. And I think
That's dollars only.
That's dollars only, right? And the crypto industry moves quickly and evolves quickly, and stable coins will get lost, the ones but to others that are doing on-chain reserves and things like that. So I believe there's gonna be a lot of growth there. And just a lot of growth in general around tokenization globally. So that's sort of what we predict for this year. Over the next 3 is kind of tough. We like to do over 5 because that seems to be what everybody else does by 2030. What is the market going to be? We've seen 16 trillion by, I think it was BCG. I think McKinsey put out 4 trillion. Standard Chartered put out 30 trillion by 2034. We think it's going to be around 30 trillion by 2030, right? And there's a lot of fringe cases that come into play here. Things like title registries of entire governments coming on chain, multi-sovereign national bonds in the $1 trillion issuance sizes being put on chain. There's all kinds of large use cases that drive a lot of adoption as opposed to, oh, it's going to grow 5-8% year over year. No, we think this is going to be a massive shift over the next 5 years, and there'll be probably around 30 trillion on chain.
Wow. Erica, beat that.
Well, to quote Elliot, it's a $150 trillion opportunity. So who knows how quick we'll get there, but yeah, use $150 trillion. So not to repeat any numbers that you shared. For the Bitcoin price prediction for Van Eck, I think they predicted $180,000 in 2025, and then Standard Chartered predicted $200,000 in 2025. So if that has any indication of what money could flow into security tokens, I think it's positive.
Okay. You a little bit more skeptical, I think, Dan.
Why is it always putting me in the spot like that? So look, I think that, I think the industry is going to grow. I think we're going to see significant growth over the next few years. I think 2025, though, is going to be an interesting year. The president needs to get his sea legs, and even though he's been in office before, and hopefully has learned more, or he comes in not as green, I think it's going to take a while to see how the SEC and other regulatory bodies react, how they implement new regulation and whatnot. So I think we need a little bit of, we're going to be crawling a little bit in 25, but we could see significant uptick in 26. I don't have the data points that Herwig and the other folks do, so I'm going to pass on that. But that my view is that it's a slow year for the industry.
Okay. Dylan, do you think you're going to be rushed off your feet as the year progresses, doing more and more of these things?
I think I need more to to come. I think we're still only scratching the surface on setting up these structures. It's still very involved work, so it doesn't take that many of these deals to keep us really busy, actually. So we may have to start recruiting if it does get anywhere near as busy as that in terms of new deals. But I think the UK is already relaxing some of their rules and providing more clarity around staking and things around the fringes of what we're doing. That will help because, as I say, some of our clients don't come to the UK. I think if that becomes more certain, that will allow more clients to form in Jersey marketing into the UK. The US is the big one, obviously. If you could market these products to the US, I think it will significantly ramp up the amount of work they're doing on these structures.
Thank you. And Philip, the last word with you for forecasts.
Well, I actually already said at the beginning that I thought we'd be where we are today 5 years ago. So in terms of forecast, probably not on the most solid ground. But I won't put a time frame to it, but I think we're just at the beginning of wide scale institutional adoption. And it comes back to a point, it's if we see that regulatory clarity, at least directionally see that regulatory clarity. But it comes again back to a more broader point, which is globally, your choices of jurisdiction matter. They do matter. And I know I have, with an American accent, I'm always at risk when I try to use irony, but you know, when I look at a jurisdiction like Jersey, stability and predictability is anchored in adaptability and flexibility. And so when you're looking at jurisdictions, as this becomes more institutionally adopted, you should be looking at jurisdictions that can deliver you that predictability.
Okay, well, that's I think a very good probably moment to end on. Thank you all very much. Those of you who are online, who are still with us, who've been following us this morning here in Florida. There will be a recording of this going up on our site probably sometime next week. And thank you to the panel here for your wise words. Thank you very much to Jersey Finance for sponsoring this event this morning. And thank you for the studio audience being with us here in Miami. Hopefully see you the next time. Bye-bye, everybody.